What happens when you get three infinite bankers together to talk about infinite banking? It sounds like a little three guys walking to a bar joke, doesn't it? But here's what happens, because this interview you've got to see. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You work so hard for that money, and you're now ready to become work optional, where you work because you want to, not because you have to. Why? Because you have enough passive income coming in that you're able to pay not just for your life's means, and you're not just here to get rich, but you're here to live a rich life. Because as you're blessed financially, as you have more financial freedom and the capacity to be able to do that, you can also serve others. You can create a ripple effect through their lives. And that's exactly what I'm here to do with you today on the show. Thank you for tuning in. Thank you, because we're now about 940 episodes into our show. We're getting so close to that 1,000 mark. Thank you for so many of you. Many of you have been here since the beginning. So thank you for being a part of this show today. Hey, I know a lot of you guys tend to be stalkers almost. You tend to watch the show, whatever, but a lot of you haven't subscribed yet. So if you haven't done so, go to the Money Ripples with Chris Miles page on YouTube, especially if you've been listening to this on Spotify or Apple iTunes. Go subscribe to our YouTube channel, Chris Miles with Money Ripples, today. Okay, so this is a special episode. You'll notice here that it'll be a little bit fun, but I invited two of my friends here, Russ and Joey, two guys from Wealth Without Wall Street. They wanted to have me on their show. And you know what? Honestly, I wanted to have them on mine. And so we did this collaborative joint effort. Because here's the thing, guys, we're not always in competition with each other, are we? We're here because we actually want to get better. We want our lives to improve. Because what I love about these guys is that they're on a crusade also to help their clients get the best. Now, granted, we all have our different opinions and views, but so many of the times, even with financial advisors I run into, well, depending on the financial advisor, in many cases, we might agree on the majority of things. But at the same time, we have those unique differences that make it that can make a massive difference in people's lives. And so as a result, I decided to invite Russ and Joey. They decided to invite me. And here's the conversation that we had about not just infinite banking, but about financial freedom, especially how do you want to create wealth without gambling on Wall Street? Check this out.
Well, I was similarly in the mortgage industry for 11 years whenever I first got a hold of Nelson Nash's book, Become Your Own Banker. And that was 4 years before I left the mortgage industry when I finally realized, I was like, wait a minute, all this stuff I had been doing, making a lot of money in the mortgage business actively, but I was tied to my phone. I was literally, and Russ busts on me all the time, I had it in a holster on my belt. I mean, I was
He did, man.
I remember guys like you.
It was sad. It was like, bro,
this
this
is
is
a
a bad fashion statement.
but you're living off of referrals, and referrals they own you in a sense, because if you don't answer, it's you get the first call, but it doesn't mean that you're not a commodity to a certain extent to where they're going to be like, well, if you can't, help me with it, then somebody else will, kind of thing. And so you just have this constant fear, like, I need to be available. I need to be taking this next phone call from this next referral source, which means you're in complete jail, right? You're on vacation, but you're not actually there. Physically, you're there, but mentally, and I have 5 daughters, and I found myself multiple times on vacation and telling my kids, my wife, hey, you guys go on down to the beach. I'll be there in, just right after this one phone call. And then 4 hours later, they're coming back up to the condo. I'm walking out, and they're just disappointed because there's dad, but he's not really there. And I did all the right things, Chris. I was putting money in my 401k. I was doing the IRA situation. I was starting to get into 529 plans, losing all access and control of my money and thinking I was really doing well. But I never felt financially free. I never felt financially successful because of what we now know is passive income has to exceed monthly expenses to be truly free.
Yeah.
And when I finally read that book, it showed me that there was a different path. I didn't know what to invest in yet. but I knew that I needed a different place for my money to reside. And infinite banking gave me that. Fast forward 4 years later, I've started multiple policies on myself, on my wife, and then I'm sitting there at a conference with Russ, and I'm like, man, why do more people not know about this? Like I felt like the kid holding gold in his pocket and nobody else had it. Like I was like, I need to start giving this out. Like there's people that need to know this. And I don't know, from a faith perspective, I was sitting there and I almost audibly heard the Lord say, you need to be telling people about this. And I was sitting there making over $300,000 in the mortgage business at the time in my late 20s. And my wife didn't work. And we had 4 daughters, or about to have 4 daughters at the time. We have 5 now. And I was like, that's a big risk. That's a big, leap lifestyle wise to go from that sort of income to zero overnight. But that was really a confirmation, and started in 2014 with Russ. And then we started Wealth Without Wall Street in 2016. And the podcast came in 2017. And that's just completely blown our minds on what all there is to invest in outside of Wall Street. Because here we are, we're sitting here with all these policies with money just, stuffed into them. And our clients are saying, what do we invest in?
Mm-hmm.
And we're like, I don't know. Maybe buy a piece of real estate. I don't know. And then the podcast taught us there's all these different places you can do it. And, fast forward now, we create over 50,000 a month in passive income just because we became investors in the process, and just from learning from other people. So that's my quick story.
I love it. Russ, I'd love to hear yours too.
Man, well, I felt like mine was your story. Like you and I are like brothers from another mother, man. Only difference is my dad was the opposite of Dave Ramsey, never saved a dollar. If I would have sat down with him, I would have been like, yeah, never stop working. And, unless you get some, more disability checks from the government or whatever, because this is not going to work out. You haven't saved anything. You have nothing. I didn't know what money was, so I became a financial advisor as well. I thought, if I don't really know anything about money, I should become a certified financial planner. That'll really teach me what not to do, basically. But at the time, I thought I knew, and then the market crashed in '08, and realized that nobody around me, all my mentors at the time, were just as lost and just as unknowing about what happened in the market and why, it wouldn't happen again. Nobody knew, everybody's looking at their mutual fund wholesaler or whatever, for the next money pitch that you're going to go tell people, oh, if we would have just done this, right? Like we would have used, more of a tactical allocation. We would have, we would have soared through this, but nobody did that, right? Like, I mean, everybody's experts after the fact, right? They can always look backwards and say, oh, but that was to me the eye-opening experience of saying, if I don't understand how people make money, then how can I really be teaching people and taking their money and babysitting it for them when there's some of those people that I think their babies died under my watch, basically. and that just led me down a path of just trying to learn. That's where I ran into Nelson Nash at an event in Orlando, Florida, and heard this concept of becoming your own banker. Be honest, at first I thought it was the stupidest idea, because it talked about whole life insurance, as you know, and as an investment advisor, that was the opposite of what I envisioned myself doing. When you watch the Wall Street movies, of how you're going to be successful and driving fancy cars and wearing fancy suits, it wasn't selling whole life insurance. That was the fat guy that was like bowling on Friday night and wearing his phone on his hip, kind of like Joey was, kind of thing. So I thought that was not very attractive. But what I did learn is that the people who had access to money were the people who had the most success. And I didn't have access to money. Everything I had was tied up in the markets. And I thought, well, okay, well, I should change that. And, I was equally as dumb by putting money in cash value. because I still didn't know what to do with it, right? Like I didn't know what to do with it when I was invested in the markets. I didn't know what to do with it when I was putting it into life insurance. So from 2009 to 2016, 2017, I didn't know what to do with money. I was just stacking it up. I'd make an
Yeah.
investment here or there, but it was usually poorly orchestrated. And I'd do it. Oh, Chris did this. Oh, okay, I'll do that. That sounds good. I got money. Might as well should invest it, right? Money burning a hole in your pocket just in cash value. And it wasn't until, like Joey said, when the podcast came and we started interviewing people and they started showing us these different strategies, where I realized that investing looked a lot differently to people than what I had been exposed to with, just a couple of single family rental properties, or, like maybe somebody buying a, apartment complex or whatever. There was so many different things. And I guess the biggest aha moment for me, Chris, was learning that I had to become a better investor. Like
Mhm.
I couldn't just hand over my money to somebody and expect it to just go up in value, just like I've been teaching. And it was ironic because I've been teaching people for the last, 8 or 9 years that you just can't give your money to the Wall Street brokers and expect it to go up, right? Like you have to
Mhm.
understand what's going on with it. But yet I was not doing that in the alternative investing space. And once
Interesting.
we really started digging into how to become better investors, is where I realized that, man, there's things that I should invest in, things I shouldn't. And we've lost obviously lots of money along the way too, right? all,
Yeah.
all those stories of what not to do now, but it's led us to a point of saying, oh, yes, the path to freedom is not by having millions and millions of dollars in accounts. It's in having cash flows that exceed our monthly expenses, and it's got to be done by us understanding how to do it versus not. I want to
What
throw
was it?
this out to you guys, and then you guys can chime in. Sorry. I think the topic that I think is interesting for our audience is because both of them hear us talk about the infinite banking concept constantly, right? Is
Yeah.
there's some, things in the marketplace that we see and hear that I would be interested, Chris, especially from your opinion, of what gives you the eeks, they're like, ah, man, like I don't like that. That I wish I wasn't seeing other people attach infinite banking in that thing, or saying it in
Uh-huh.
that manner, like because there's definitely goods and bads and all things that are out there. But what are some of those things that make you kind of cringe when you see it?
Oh my goodness. I know you beat me to the question. I had other questions for you too, but no, let's just go there because yeah, the thing that gives me icks, I mean, my first experience buying a whole life policy was from somebody who gave me the Nelson Nash book, told me to read it, and that's where I started to drink that Kool-Aid, and the only reason I did is because all these real estate investors just said it was the best thing since sliced bread. But it was sold to me very much as like you're going to build this up over the long haul, and then eventually you're going to buy a car with it, right?
Right.
And that was one of the biggest ones I knew was a mistake. I mean, that was number one was the reason they had to say that, why you had to spend so many years, because it was so expensive. Like it was all base premium, no paid up additions, right? Like you're buying straight whole life. And I remember Garrett actually went on the radio to debate a real estate investor on the topic. And they advertised it for days. It's gonna be like the showdown. And Garrett got his butt handed to him. It was horrible. And I was cheering for Garrett. And then I was like, that was nothing. It was all the thing I see with infinite banking is there's a lot of platitudes, but there's not like anything that says, hey, this is how you're actually going to get ahead as an investor, right? It was never from an investor perspective. It was always from an insurance agent perspective. And so I was sold that, you just buy it. It's expensive up front. That's why I lost my policy in 2008 because I paid like 25,000 in premiums, zero cash value. So when I hear people out there saying like, oh, that's the best way to go, you should have max death benefit. That's another one I hear from some of the older school infinite bankers, right? Max death benefit, always go that way. It's very Guardian based, Guardian company based. That one was what I was sold, and I lost my policy. By the way, I asked him up front, the agent that set it up for me, I said, listen, can we pull some different levers where I can get more cash value into this? Because I knew in my previous financial advisor days, I could set up like VULs, right? Very universal life, index universal life. That's another one we should go on to. But like I knew you could pull different levers to get higher cash value, right? I would get paid less commissions if I did that, but I get higher. And the agent told me with whole life, he's like, no, you can't do that. You'll turn it into a mech. It'll get taxable. So I said, okay, I'll take your word for it. Then I found out later that he lied, right? And I confronted him about it. And he finally just said, Chris, I just designed it that way because I couldn't afford to cut my commissions. And that scarcity mindset I see happen so prevalent. I know there's some people that say, here's the kind of split you should see in a policy. And they have their different numbers they throw out there. I won't mention names, of course, because they're probably mutual friends of ours, but they say that. And I'm like, there's nothing that shows that that's true, right? That particular percentage split is any better for the client, short-term and or long-term, right? So that's one. Two, like I mentioned, like you buy cars and houses with it. I've realized after I got into it, they always tell you to pay in, you pay yourself back with interest, right? You just pay yourself back interest. I'm like, oh, like a 401k where literally there's interest you're paying back to yourself. That's not the case with whole life policies or infinite banking strategy, right? It's no, you're paying a principal interest payment, but you're still paying interest to the insurance company. So why, if I just got offered, this is literally a year and a half ago, I got offered a 3.99% car loan offer. Why would I take a 5 or 6% loan on my infinite banking policy other than not having a required monthly payment? That's maybe one argument. But other than that, I'm like, no, I'm going to leverage the bank all day long for money that's relatively cheap, that is not my own money. And then money that the banks won't give me, I'll go use my policy for that. Whether it's a down payment on a property, whether I'm investing in something where obviously I can't get bank money to borrow to go into investment, I'll use my policy for that kind of thing, or just, keep it in cash. Right. So those are the things that kind of drive me nuts that I see from a lot of the, YouTube or influencers that we see today. Obviously IULs, people saying that you can use IUL for infinite banking. We all know that Nelson Nash never intended that to be the case. So just that kind of stuff, that just drives me nuts. I don't know what are some things that you guys would add to that?
Well, I'm going to jump in there on the IUL VUL train because, like you, very similar background. That was where I started. If I did any insurance early on, it was a variable universal life because we're using the stock market. That was the best way to build wealth. And you're using the wrapper of the insurance company to help you build it tax-free, right? Tax deferred, all of those things. And the thing that nobody tells you about is that when the market goes down, you have this double whammy, right? Because you're paying insurance on the difference between the death benefit and the account value. And every year, the insurance gets more expensive because you're 1 year older, right? So you're buying, 1 year basically renewal term insurance. And if you have $1 million death benefit, for instance, and you had 100,000 of cash value, and the market goes down 30%, well, now you're buying death benefit not from 900,000, the difference between $1 million and 100 grand. You're buying the difference between now 70,000 and $1 million. So your expense has gone up because you're buying more insurance, but also now you're a year older, and so you have this double whammy effect. And I saw these variable universal life accounts double, like just going down to where people had to go and put more money in them just to keep them alive. And then I had I acquired, some people who, I don't know how you said it earlier. You said from financial advisors who had failed or whatever, you adopted them. I had a couple of those, and I had some people in their 80s that had bought variable universal life policies, 15 years prior, and these insurance policies are about to lapse, and they're like, I mean, the husband was literally on his deathbed, and she's trying to figure out how she's going to make this premium that if she doesn't make the policy lapse and all the money that she's ever put in there is gone. And more importantly, the death benefit, right, that she was kind of banking on was going to be gone. And it was really, really scary for them to try to figure out how they were going to pay those premiums. And then IUL is, people love to show the illustrations, right? Like it's just like going and pretending that the guy showing you his investment deck is going to work out exactly the way they're showing it, right? Like, insurance is not meant to be bought for, the best case assumptions. It's meant to be bought when you're in the worst case scenarios. And I think the IUL was one of those that was like, oh, well, it can't lose money. And that's a false-ism too, right? Like they have floors that says the account can only earn X amount. But again, if the underlying index doesn't earn anything that year, the 4 to 5% expense charges with internally can actually make the account go down. And when that goes down, the same exact thing I was talking about with variable universal life kicks in. You're a year older, you're paying insurance on the difference between the account value and the death benefit. And so now it has this double effect. So any years where we
Yeah.
had down years, those things really have trouble. And I came to love about whole life is that it gets better every year as we get older, right? Because to be
Mhm.
honest, I mean, we're all have high capacity right now where we are in life and understand all the things we're doing. But when we get older, I mean, I was at a funeral yesterday of someone who was in their late mid 80s. My guess is they probably wasn't operating at the highest capacity of understanding how to handle their, life insurance policies at that point. And they don't need to
Yeah.
be worried about, oh, are my expenses getting getting higher, and then is this thing getting ready to lapse?
Yeah.
Right.
And I would just add the thing that kills me is the idea that you can get rich by financing expenses,
Yeah.
right? Like buy all your cars and that's going to make you make all this money. It's going to be the
Pay
best
all your
thing.
bills.
Pay all your bills through it. And, that's how infinite banking makes you rich. There is no substitute for becoming an investor. Like we've already said it, you can't abdicate it to a financial advisor, even though that's what Wall Street wants you to believe. And there is no substitute of, oh, I know how to buy cars, so I'm just going to use this new system to magically make money off of buying an expense. You
Yeah.
have to actually invest. You actually have to take cash value in this case, borrow against it, go out and buy an asset that produces passive income. Until that happens, you're no better off. I don't care what system you're using. And so when people peddle that idea, or a similar idea is, well, if you just buy a policy and then you borrow against that policy to start a new policy, and you
Yeah.
just keep laddering these policies, magically you're going to have more money at some point. There's still an input of a premium, and there's a you still have to take that cash value to buy a productive asset. That borrowing against one to borrow the next one. There are times for that when you're preparing for a windfall. Okay, there's so don't
Yeah.
hear me like poo poo the idea completely, but the 99% of people that are being told to ladder policies like it's going to be a magic pill for them, bad idea. It is going to explode, and they're going to be like, wait a minute, I thought this was supposed to make me rich. And anyway, so those are my top two for sure.
Yeah, those are all great ones. I was actually, this kind of leads to what the question I want to ask the two of you, because you came from that saver mentality, just like I did back in the day, right? But you were even more recent than I am when you started to convert, not just the whole life concept, but even like passive income. What was it that got you to believe that saving in a whole life policy was better than just putting it in cash? Because I hear so many people saying, give me the argument. They'll say, well, shouldn't I just have savings? Then there's no money coming out for the death benefit. I don't even care about the death benefit. I just keep it in savings and I invest it. I'll make more money now. So why should I do that versus using whole life? What's your answer to that?
Well, I will say, the thing that got me early on was Nelson Nash talking about human behavior. And I resonated with it so much, right? I saw my dad who would spend every dollar he had, right?
Mm-hmm.
And we would go to the pawn shop and pawn his guns or his, tools sometimes in order to make his mortgage payment. And it I just knew human behavior, and then because that he didn't wanna lose those guns were important to him, then he would go to work to make enough money to go
Mm-hmm.
back and get them back, right? Human behavior took over, and when Nelson Nash talked about the human behavior inside the Becoming Your Own Banker book, I resonated with that because of my experience, and I thought, if if I didn't have a place to save, right? Like in theory, that question makes sense, right? For the person logically saying, if I just saved money in a savings account versus put it in this whole life policy, I would have more money. And for the first probably 7 to 10 years, it does make sense, right? Like that math does add up.
Yeah.
But the difference is that also I know what human behavior says is that once somebody gets a certain amount of money in any account that they can access, they will use it, right? Because either they'll use it for expenditures, or they'll get nervous and say, "Oh, it's costing me too much. I'll spend it or invest it," right? And they'll make decisions maybe emotionally, and most financial decisions are not well done whenever they're emotional. And so I totally bought into the concept of having a place that I know it's not earning tons, it's earning 3 or 4% over a long haul. Now that is tax free and all the benefits we get, but by
Yeah.
putting money in there. And then I experienced that personally. I started saving like $25,000 a year. That was my first insurance policy I bought on myself. Kind of you use that 25 grand. I'm like, man, our stories are so stinking similar. And I wouldn't have saved 25 grand. And by the way, the next year when that $25,000 was due, I was like, crap, how am I going to make this thing happen? And so I had to switch it to monthly. But still, I would have never been able to put in that $2,200 a month or whatever the monthly amount ended up being if I wasn't forced to do it. So it forced me to save money. And if left to my own devices, there's no real force for me to put money in a savings account.
True.
So I that's where I would say you mentioned this, and I'm not trying to contradict you. I want to like say I agree with you on when I buy a car, if I can buy it at 3.99%, I will do that from the bank. I do also buy into there's certain people that have heard infinite banking, that they started the insurance policy for the purpose of saving money to finance their cars, right? And while that is not magical in a financial way, it forced them to save money that they otherwise wouldn't have done. Now, once they
Good
get
point.
there and they're like, okay, Russ, should I borrow the money from the insurance company at 5, 6%, whatever, or should I go to the bank at 3.99? I'd say you should go to the bank at 3.99. But knowing that the reason they started the insurance policy because they wanted to be in control of the decision. And it's like, now
Yeah.
you got the choice. So for me, it always came down to human behavior was I would spend the money and I wouldn't be forced to save it. Now saving hundreds and hundreds of thousands of dollars every single year into whole life policies. There's no way I would have done that. Like I wouldn't be saving that money in checking accounts and savings accounts. I would have spent it.
Good point. Yeah. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
Yeah, and I'll take it more from my first idea in this came with at the time I'm learning about this, interest rates paid in banks are 0.001%. I mean, ridiculously low return. So it's almost laughable. Like back then you wouldn't even talk about it being a savings account. It's just another checking account, just called a savings account, right?
Yeah.
So it it wasn't too hard to convince me that this has a better rate of return internally over time than a savings account. But then the idea that I could leverage it over time and get two things working at once with whatever I was going to use for saving, like use that savings for, and the actual savings itself, I was like, well, that's better than one, right? I'm a pretty
Mhm.
simple minded guy, Chris. Like two is better than one in my mind. And then at the end, it actually has a tax free death benefit that passes on. There's this kind of built in estate component that I wouldn't have had otherwise, because up until that point, I think, Russ, you can correct me if I'm wrong. I think I had $2 million of term death benefit when I learned about this. And I'd say this all the time. Once I stopped thinking about death benefit, and by the way, if you asked me at that point, I was like dad of the year. I'm like, dude, I got $2 million of death benefit. Like I am something, you know? But when I started thinking about it from a what could I do with cash, and I started solving for infinite banking by putting more money into cash value, all of a sudden I had over $3 million of death benefit just like that.
Right.
And now that number is significantly higher. But
Mhm.
even out of the gate, I more than solved for my death benefit needs, and it was going to be there forever, not just until a certain point in time where it would, go away. So mine was more, I guess, logical in nature, less about the human behavior problem, but I now see the human behavior things that Nelson led in his book with. So, yeah, for sure. That's what led me down there.
Interesting. Yeah, I love that. It reminds me the other day I was driving and traffic was starting to get thick. It's a freeway. We had like 5 lanes, right? And we're going down the freeway. And I was just thinking, okay, I'm stuck. I'm in the lane. I can tell it's slowing down. Everything's slowing down, but I can see the left lane is faster. And so I could have just waited till eventually there's opening, but you know how it is. There's cars behind you and you're never going to start speeding up and closing on those gaps. So I slowed down. I braked even though I was in the slow lane, I braked even more, got slower just so I can get to the other lane faster and then I can go further ahead. So yeah, I let that traffic get a gap between me so I can go ahead. And I kind of see that with the, when it comes to life insurance too, right? When those first few years there's that net cost. And it's funny how people nickel and dime over that little bit, like you said, regardless of the emotional aspect, they'll say, well, based on my calculations, right? Based on my calculations, this is what I'm seeing here. It's like, yeah, but if I can slow it down to then shift over to this new lane and it's faster overall, and yeah, I'm going to take me a few years to catch up, but eventually, like 5, 10 years later, I'm going to have more than if I put it in the bank in the first place, anyways. And I can still invest it and I can still do things that you say you can do also with a bank account. Why not? But it's that short term sightedness I see so many people get locked into, and they just don't see that, when you do invest more than just 5 years, it does make sense.
Yeah. So I would love to talk more about our individual experiences around, you know, what infinite banking did, but then leading into the passive income side. It sounds
Mhm.
like, Chris, if I can start with you, you started with the passive income that then introduced you to infinite banking. Did I get that right in your story?
It was about the same time, but
Okay,
they
simultaneous.
separated it though. They didn't have them as the same. I later learned to combine them together and make them work together versus working independently of each other.
Okay, so talk about like how you learned about passive income then in light of where you're at today.
Yeah, I mean, so I first learned about it, like I said, like right about the time I was right before I quit being a financial advisor, and I started seeing this new world of alternative investments, right? Things I never even thought possible or was out there because I couldn't sell as a financial advisor, right? I was licensed to sell, not licensed to make people money. I even have a shirt. I didn't wear it for our podcast today. I have a shirt that says like financial advisor, like a definition in a dictionary. It says person that paid to sell you crap, not make you more money. And that's what I was, right? And so when I learned, and this was the big epiphany for me, because I even back then I taught if you're going to retire, you live on 3%. Because the 4% rule, we questioned that even 20 years ago. And even today, they've debunked it so many times. But how many people, even the FIRE movement, the financially independent retire early, I got booted out of the Facebook group, even though I did it twice by the time I was 39, which was technically FIRE twice. I got booted out because I told them, hey, if you're trying to do it when you're early, it's a 2% rule, not 4. And they didn't like it.
Oh
And by the
yeah.
way, don't use mutual funds. They suck. That might have been the real reason they put me out of the group.
Oh man, if
I might
you
be
start talking
candidly.
about index funds in that fire group, you are just a leper.
I know. I was the weirdo. I actually was fire. Go figure. But anyways, I digress. But yeah, like when it came to passive income, that I was teaching 3%. So in my mind, back in like 2003, 4, 5, my whole goal was if I could save up $2 million, I can then live on 5,000 a month or 60,000 a year, 3%. And I thought that was the dream. And so if I'm just cheap enough from my 20s until my 40s, maybe I can actually retire young at that 3%. Because back then 5,000 a month was more like 10, 12,000 a month in today's dollars, right? I
Right.
wasn't factoring for inflation, obviously. Well, when all of a sudden, like my friend, that was in the real estate space, he's like, well, look, I'll borrow your money. And this is, of course, 2006, 5, 6. They're overly rich in how they're paying in hard money. He's like, I'll pay you 2% a month. And so I did the math. I was like, wait a minute. So if I have $100,000, instead of living on $3,000 a year or 3%, you tell me I can have $2,000 a month with 100 grand? Holy cow. And then this whole world, like it was like angels singing, right? This chorus of angels. Cause I'm like, this is incredible. Like I can live on 2,000 a month. That means you only need a couple grand, and I only needed 3,500 a month to be financially independent. I was like, I don't need that much. And by the way, if I sell my house, which has all this equity trapped in it, because I was trying to pay off the house, because I was on that same Dave Ramsey path, like my dad was before Dave Ramsey was Dave Ramsey, right? I was trying to do the same thing. Like sell the house. I actually sold it to an investor at full appraisal, leased it back from him, and then subleased it out to turn into a rental, is what I did with that house. And so the next thing you know, I was able to strip out my equity, and we called it equity milling back then, stripped it all out, and then I can invest that money. And that's basically when people are like, well, how did you do it? That was how, right? It was like, I was just cashing in all my chips, stripped out the equity, got my money out of prison, as I say today. That's why I tell people don't lock your money up in 401ks and IRAs and stuff, because you're just locking away in prison where you can't get to it. So get it out, and then, get it out of the prison, get it liquid, and then you can get it out into other investments. So that was the thing for me, was like, wow, like this is actually possible. There's hope, and that's what got me so excited. And that's what got me telling friends and some neighbors and stuff, like, here's what I'm doing. It's so awesome. You can literally lend your money out to investors and make money. And nowadays it might be like 10, 12% or so you might make, but still, I mean, there's great things you can do, and even today, I mean, like, I know you guys and we have similar investments we've done. I know I've done stuff with raw land partnerships. It's been awesome. It's been great. And I've done oil and gas. I've done, multifamily. Some of it's worked, some of it didn't. I've done single family turnkey homes and stuff. Like I learned now this time around, the second time around, passive was better than trying to be the active investor, like fix and flips and stuff I was trying to do back in 2006. For me, it was better just being the hands-off investor and let other people do the hard work, so I don't have to.
And like today, what's your number one go-to for passive income personally? Like that lines up with your investor DNA, as we call it.
Today, it's always market dependent, depending on where I'm seeing the trends. The last 3 years, I've been doing a lot more with lending, actually. So more like hard money loans or things like that, where there's some things backing it up, but there's still opportunity. But if you would ask me 5, 6 years ago, 7, 8 years ago, I would have said turnkey rentals, that were, I mean, you'd get cash on cash, like 12, 13, 14% back in those days before the interest rates went up, and on top of that, like, I mean, it was just like the rents would increase every year. I mean, I made great money with that, and with with great leverage too. That's the one thing the market doesn't offer. Even when I was stock trading and teaching people how to trade stocks and options, it wasn't like you could borrow money necessarily to go and invest, right? Like, yeah, you can do some things with brokerage accounts, but not like real estate where I could put a 20% down payment, and then if it appreciates 10%, I actually make a 50% return on my money. I mean, you can't do that in the stock market. You really just don't get that kind of benefit, at least not without risking everything potentially and losing everything in the process.
Right. So Russ, same question. Like you went from the infinite banking, stacking up a bunch of cash, to then the passive income idea. What was it that clicked for you? And like, what is your kind of go-to passive income idea today?
Well, the thing, Chris, that we talk about on our show is like I learned this. We coined it, the phrase, before we read it in Garrett's book, this investor DNA. He loves that, by the way. I think
He loves taking people's other terms and ideas.
no, I mean, I think he
We
wrote
stole it from him,
the
so
words investor
apparently.
DNA long before we ever said them on our show, and came up with
Oh, I gotcha. The
uh,
reverse. Got it.
yes. I think we have created a really cool visual and process that even he gave us credit for. That he's like, man, that's awesome. And he hasn't, like, had a copyright claim on the name against us, so we're still friends around it. But I was listening to, it's the son of
Tom
the
Wheelwright, right?
yeah, Tom Wheelwright, and the son of the Colby founder. I can't remember that son's name, but they were talking about this and on Tom's show, and Tom said something about, like, whenever he had investor clients come to him and wanted to know if they should do a real estate deal or whatever, he would have them do the Colby, and he would give them
Mm.
feedback based upon that. And I thought, man, that's fascinating. We should do that, but for all these different passive income streams.
Mhm.
And we reached out to Colby, and they wanted to charge us $50 for every um, assessment we did. We said, well, what if we bought like 1,000 at a time? And they're like, okay, that would be 1,000 times 50. I mean, they were like not budging on that price point. We're like, it doesn't seem reasonable. So we did some search, and ultimately we landed on Disc, and Disc would give us a
Mm.
discount, and they actually allowed us to add our own verbiage into their printout. And
Yeah.
as a result, we developed this concept where we take the personality of somebody and the way that we see the world, and we use that to analyze whether or not they would like investing in certain things. So we have kind of this pros cons list. And
Mhm.
where all that originated from is that the first deal I did was a single family rental property. And I mean, it didn't matter. It was kicking out $90 a month, whether I liked it or not. I hated it. And it wasn't that it was just such a small amount of money. It was that I literally couldn't influence its outcome because it was
Mm.
in a city like 2 hours from me, and had a property manager, and I couldn't raise the rents, right? I couldn't
Mhm.
pick the tenants, couldn't do anything with it. And I didn't know it then, but the part I disliked about it is that I kind of like to be a hands-on kind of person. I like businesses and investments that I can kind of manage. And Joey and I are currently buying businesses and rolling them up. And
Mhm.
like our gifting maybe is how to take an investment and turn it into an operating company and put people in place and install systems through just our just experience in business. And I hated it. And we got to a point where we interviewed this guy on short-term rentals, and I was fascinated by it. And Joey and I were just sitting there talking about, well, how could we get this started? And he had a short-term or had a long-term rental at the time. I was like, well, let's do this. Let's take the next year, kick that person out of there, and let's put it on short-term rental and put it on Airbnb.
Mhm.
And the worst case scenario is, like we have to pay your mortgage. I'll pay half of it. You pay half of it. We'll figure it out. And that's what we did. And we started with one, and we ended up with over 25. And we just built this business, and we installed an operator, and we could use our influence of one being able to influence the operator to do a better job, right? Like we could give them training to learn how to do it even better. We could use our platforms to like say, hey, when you're traveling to Birmingham, go stay at Wake Up in Birmingham.
Mhm.
And it allowed us to kind of scratch that operating company itch that we really enjoyed. It was a passive income. Like we didn't answer the first call on Airbnb. I didn't take
Mhm.
toilet paper to not one single unit or do anything, right? Like, and so it was as passive as any of the other investments I had, other than an hour call a week where we would sit there and look over the financials and give feedback. And man, we were, at the height with probably, netting 25 to 30,000 a month after paying all bills, paying everything. And
Yeah.
I thought like this is the connection. And so for us, it's like connecting that internal thing that we have and what we want to do. And for people who want the opposite of that, well, purely passive, like that's what that investor DNA was meant to do.
Mhm.
Is like to say you're gonna hate this about it, or you're gonna
Yeah.
love this about it. And that's what clicked in my end.
Yeah. And for me, I'll just say that I had that same background that you have, Chris, in the mortgage business. So my initial thought is just lending,
Mhm.
right? Like, in fact, right as I left the mortgage business, I had two people within a relatively short amount of time. It was like within the first 6 months or so of having left, they both called me and they're like, "Hey, I don't really fit a traditional mortgage, but I've heard that you may be interested in lending." And I'm thinking, I don't even know how you got connected to me, but I end up doing private mortgages at 10%. They weren't even like hard money type deals,
Yeah.
but they were for owner occupants with 20% down on
Wow.
15-year notes. And my biggest failure in that was I made them 15-year notes, and I
Yeah.
didn't have like a shorter, turn time that I could like roll it
Like a
out in
shorter
two
exit.
years or whatever.
Yeah.
But that was my initial thought, is like, just do something that which I think was a good first step.
Mhm.
But from there, it was like, man, we need to do things that will increase that passive income and not tie up the money for as long as I did on those mortgages per se. And so right now, what I would say my favorite thing that we've done is the land business with Mark Podolsky, the landgeek.com. If people have listened to him, we became friends and learned his model. And we were like, we got to do this. To Russ's point, we got to figure out a way to make this an operating business that we don't run. And at the time, there was nothing. It was like, well, maybe we get our assistant to run it, and we'll do that. She has some extra time on her hands. She wants to build some passive income. We'll work with her. And it was a disaster. It did not yield passive income. It yielded passive payments for the
a lot of
land.
headaches.
Yeah, and headaches.
Active headaches.
Active. Yeah, I would say it was less passive. And so we went back to Mark and we said, hey, we got to do this, but we can't do this current model. What can you do? And so we hired their team to do it for us. And now that one business yields us almost $35,000 a month. And it's all notes. It's all secured by actual dirt. And we have no tenants, no toilets, none of the termite issues that you would deal with in rental properties. So,
Chris, you're involved in that deal, right?
Yeah, I was actually mad at you guys. Well, really, I was mad at Mark because I told him years before you guys did that deal. I said, if you ever have a passive opportunity where I can just hire you to do this, I want to know about it. And he's like, yeah, sure, of course. You know how he talks. He's like, yeah, everything's possible. And then of course I hear you guys are already at a deal, and then several people are already like on a waiting list. I'm like, wait, what? Like, why didn't you talk to me, man? Like, so yeah, I got involved in one, like it's been almost 4 years now. So it's one of my favorites.
Our gifting is influence, man. I'm telling you,
blaze the trail for you, Chris.
We've seen and talked to so many people who are like, man, I'm in that deal with Mark Podolsky. That's so awesome. Like, well, you can thank me and Joey. You can take us out to dinner anytime you want to, because it took many efforts he told us the same thing I think he told you. We just are, you could ask our wives. We don't take no for an answer. Like, this is just we're gonna keep after him, and we did. And ultimately he caved, and I think we helped him see some vision of what's possible, and hey, you could do this, you could try that. What about this? And we're not going to micromanage you. Like, we're going to be completely hands off. And early on, there was very bad reporting, very lack of communication, not a whole lot of, investor, relations, if you will.
You're breaking them in.
But it's been fantastic. And I've heard and talked to so many people that are doing that with him and having success, and have even known people who sold their business. Like, they started the business with him, and they needed to exit, and they exited, and they got twice what they put in, and they were like, man, it's totally worked, and there's been a number of people who are like, I get a message, it seems like every 2 or 3 months, somebody wanted me to talk to them about it. I'm like, here's every month we do a podcast and we talk about it. Just go listen to it. I don't need to tell you any more than I tell the public. Well, I know we need to wrap this up.
The thing you guys talk about with investor DNA, that might be something we have to integrate in our community somehow too. Maybe we could joint venture or white label or something with you guys. Cause when we work with our clients one-on-one, that's one of the things we have to discover, right? Because everybody's different. Everybody has a different way of investing. I have some clients that absolutely hate being in the raw land partnership. They're like, I can't stand it, and especially the ones that want like quick wins, right? They want short-term wins. It's like, no, those that want a longer term, they're like, hey, I'm okay. Let's grow this sucker. Let's make it big. But the ones that want short-term wins, it's like, no, that's not what this is, right? And so matching up the right investments for the right people, everybody has their own recipe, their own thing. And so I love that you guys do that, because it really, everybody is different. There's no one size fits all. If you ever listen to a show where everybody says you should all do multifamily, or everybody should do self-storage, that's exactly what they're selling you.
Well, we tell people we are definitely investment agnostic,
Yeah.
and if it produces cash flow, we're interested. I know we need a wrap. I'd love maybe like a um, electric round. What do they say? We don't ever do this, but the
Lightning round.
lightning round,
Yeah,
electric lightning.
lightning, whatever. That's what
Dating. Yeah.
rednecks say.
Yeah,
Electric. Yeah.
exactly. Right. For those non iPhone users. All right. So lightning round. Here's a question that we get asked a lot, but I think we need to answer it for people, and we can do it quickly. Each one of us probably have at least one. Who or who is wrong for infinite banking, right? Infinite banking doesn't work all the time, right? People ask me like, what's the downfalls or what's the negatives? I will hear you guys talking about the positives. Obviously, you make all this money selling it. You live fancy lives and all that stuff. And which, by the way, none of that's not true, right? We do make lots of money and we do live fancy lives, but it's because we help lots of people, right? I can show you lots of people who sell life insurance that don't do any of that, and it's because they do it the wrong way. But what is the thing, Chris, that you would say you tell people don't do it because of this, or this will go wrong if you try this?
Yeah, beyond what we mentioned about trying to use it as a bill pay account, definitely don't do it for that. Don't put all your income in. But I think in just general, the one thing I tell people is if you're paycheck to paycheck, this is not for you,
Mm.
right? Like if you're literally like you're just barely making ends meet, find ways to free up some cash flow first, get the cash flow under control, then do this. Because I think for it to really do something, you should be able to save. You want to be able to save at least $5,000+ a year to make this at least halfway decent. So that's why I say if you can't save at least 5,000 or so a year, don't do it. You can always buy a convertible term policy and convert later on when cash flow is better. Also, if you're over the age of 70, I've noticed that typically, I mean, the whole infinite banking type of strategy where you're trying to use it and leverage it, maybe not so much. I would look more from estate planning purpose when you get in your 70s and well, especially in your 80s. And then of course you're in bad health. But of course, even with bad health, if you have somebody in your family that is in better health, then there might be a way around. You can still make this work. And I've had people do that too. So it's really, definitely paycheck to paycheck. If you're that way, don't do infinite banking. Like it's not going to save you, in the sense that you're going to make more money just out of nothing. That's not what this is. Like you need to get your cash flow under control.
Joey,
Yeah,
what would you add to that?
my add to that is not necessarily physical in nature; it's mindset. If
Yeah.
you now the chances of you being this person and you listening to this podcast are pretty slim. But if you are one of those that's just like terrified of being different or
Mhm.
of kind of thinking outside of the box, like you need a very specific box and you can't see outside of that. Like you're like, man, I just need to stick to the herd. This is not for you. It just will never feel right. You will always second guess it. You will always question yourself. And all you need is one of the other herd to say, what are you doing? What, you bought life insurance? Oh, you got scammed. Oh man, the dumb people put money in life insurance. Like, by the way, banks put billions of dollars, so they must be the dumbest of all of us. But if you can't think for yourself, if you can't get outside of the box, don't do it.
If you thought Anthony Fauci was a good man, don't do it.
Oh man. Only thing I would add to this, I think that people fall in love with the safety of it, but then never actually utilize it.
Mm.
And I think that that's the downfall that you have, because savers are losers, right?
Yeah.
Like it truly is. Ultimately, if the government is printing money at a pace that it's going to be hard for us to keep up, right? Like it's crazy. This new big beautiful bill, like the best case scenario is in 10 years, our national debt is only $56 trillion. I don't know if you guys know that, but that's
Insane.
the best case scenario right now, if that goes through as is. So from that perspective, like we can't outsave that. We're not going to earn 3 to 5% and keep up with that. We're going to have to put the money to work. So you're going to need to become an investor. Like this is just going to have to be an element that gets you in the position to become an investor. That's why I love it, is because, like you said, I think, Chris, you have to have access to cash to become an investor. But you're going to have to learn. You're going to have to take action, and maybe that requires you to invest in yourself and all the other things. But I would say don't do it if you're just going to try to save your way to wins. I think maybe over time you can do that evil thing at the Wall Street, just let it sit there forever and then let it outpace the life insurance company. That probably would happen over a long enough period of time. But if you're going to use it, you got to use it or you'll lose it. I think that was something Nelson Nash said too. So, man, Chris, thank you for letting us do this crossover episode. I think that was fun.
Yeah.
And
No, we had a lot of fun. I know my listeners enjoyed this too. I can guarantee it. So I really appreciate you guys having me here.
Likewise.
Absolutely. Well, thank you for listening. Whether you're on the Money Ripple Show, Wealth Without Wall Street, share this with somebody else. If you're listening to Wealth Without Wall Street, add Money Ripples to your weekly download, and definitely get more insights and information from Chris. And thank you for listening. Have an amazing day.